Have you ever looked at a market, maybe silver, and just wondered what really causes those sudden, almost vertical price spikes?
Yeah, those moves that seem to come out of nowhere.
Exactly. And what if there's this complex system underneath it all, like a hidden plumbing, that if it gets really stressed could signal something huge, maybe even a once-in-a-generation kind of event?
That's a great way to frame it.
Well, today that's exactly what we're diving deep into. The pretty intricate world of silver short squeezes.
And we're using a really comprehensive guide, one built specifically for retail investors like you, to help cut through all the noise and speculation.
Our mission here is basically to help you separate the real, verifiable signals from, just hype, understand the unique way the silver market works, and approach it with a disciplined framework.
It's about getting properly informed,
Mhm.
right? Not just on what a squeeze is, but how to spot the genuine conditions for one, and importantly, how to manage the risks that come with it.
We're going to walk through this guide kind of slide by slide to really unpack everything you need to know. Okay, let's unpack this guide. So first up, the title itself sets the stage. The Retail Investor's Guide to a Silver Short Squeeze, a practical framework for signal recognition and risk management. Think of this whole deep dive as basically your shortcut to getting your head around a really complex topic.
And right away, the guide hits us with the top takeaways. These are absolutely crucial.
Okay, let's hear them.
First insight. A true silver short squeeze. It's
Yeah.
rare, genuinely rare. It's not just Twitter chatter. It needs two powerful forces hitting at the exact same time.
Which are?
You need panicked short sellers being forced to buy back their positions, driving prices up, and you need real acute stress on the physical delivery mechanism. Like the system for getting actual bars is seizing up. Both engines have to be firing.
Got it. Dual forces. What else?
Second, and this is maybe the most important thing to internalize, silver is not a stock. It sounds simple, but the market structure is way more layered.
Right, you've got futures, ETFs, the physical metal itself.
Exactly. And here's the key difference. The paper supply futures contracts, ETF shares, that stuff is super elastic. Banks and authorized participants can create more pretty easily in theory. But the underlying physical supply, the actual 1,000-ounce bars you can deliver, that's inelastic. You can't just magic up more silver bars overnight. That inelastic physical supply is the core dynamic to watch.
Makes sense. Paper expands, metal doesn't. Not quickly, anyway.
Precisely. Third takeaway, remember that exchange power is absolute. History, like in 1980 with the Hunt brothers, and again in 2011, shows that exchanges like COMEX will absolutely step in if things get too wild.
How so?
They'll change the rules mid-game, hike margin requirements, making it way more expensive to hold positions, set position limits, or even force liquidation-only trading. Basically, they have the power to kill a squeeze and cap the price spike. It's a major risk factor.
Okay, so don't fight the exchange. What's next?
Fourth, trying to perfectly time a squeeze. Forget it. It's impossible. The real goal is to identify these high-probability windows where the conditions seem right.
So looking for a pattern, not a pinpoint moment.
Exactly. Your analysis has to focus on a confluence of signals all pointing the same way, not just one single data point lighting up.
And the last key takeaway.
The most reliable signs, the ones that really tell you something serious might be happening, involve a breakdown in the arbitrage mechanism between the big silver hubs, London, the LBMA, and New York COMEX.
How do you see that?
You see it in things like the exchange for physical EF key mechanism acting weirdly, but most clearly, you see it in persistent backwardation. That's when spot prices are consistently higher than futures prices. That's a serious stress signal from the market's deep plumbing.
That idea of plumbing is a great transition. Let's dive into what a silver short squeeze truly is, and maybe just as importantly, what it isn't. Because honestly, the term gets thrown around a lot.
It really does.
So a genuine squeeze isn't just the price going up fast. It's a rapid, kind of chaotic price surge fueled by a feedback loop. You've got shorts being forced to cover their positions, buying frantically.
And at the same time, there's this urgent demand for actual physical deliverable metal bars that just completely swamps the available supply.
Right. It's very different from, say, an equity squeeze like GameStop, which happens in a much simpler two-layer system. Stocks are just shares, right?
Silver's got this complex three-layer stack, and all three have to be under pressure at the same time for a real squeeze.
Okay, break down those layers for us.
First, you have the COMEX futures market. Think of it as the global nerve center for price discovery, and it's where the big 1,000-ounce bars get delivered.
Well, wholesale level.
Yep. Then you have the exchange-traded funds, ETFs, like SLV, PSLV, popular ones. These are often the main way retail investors like you get exposure.
The main on-ramp for many people.
Exactly. And finally, underpinning it all is the physical market itself. All those large silver bars stored in vaults, mainly in London under the LBMA and also in New York COMEX vaults. A true squeeze has to ripple through all three of these layers. And that brings us back to this idea of paper elasticity. Remember, a company has a fixed number of shares out there that's inelastic.
Right.
But with silver, the paper side futures, ETF shares is highly elastic. Bullion banks, the authorized participants, APs for ETFs, they can create more of these paper claims relatively easily.
To meet demand.
To meet demand, exactly. But, and this is the crucial but, the underlying physical asset, those 1,000-ounce bars, that supply is inelastic, especially in the short term. Mines can't just double output tomorrow.
So the whole squeeze idea hinges on this mismatch.
Precisely. The premise is, if you demand so much physical delivery, you force the elastic paper market to actually make good on its promises against that finite inelastic physical supply. That's where the system can potentially break.
And that potential breaking point leads directly to rule risk. Unlike the stock market, where maybe trading gets halted for a bit, in commodity futures, the exchange itself, the CME group for COMEX, has a powerful, historically proven toolkit to just stop a squeeze cold.
They don't mess around.
No. They can jack up margin requirements dramatically, making it painful to hold long positions. They can slap on position limits. In extreme cases, they can even mandate liquidation-only trading.
Which basically kills any buying pressure instantly.
Right. It acts as a hard ceiling on the price. So just seeing the price rise isn't enough. You need clear, verifiable signs of stress deep down in the market structure, that plumbing we keep mentioning.
And the authorized participant, the AP, is a key player in that plumbing. They're the link between your retail buying in an ETF and the wholesale physical market.
How does that work?
When lots of people buy, say, PSLV shares, the AP has to go out and source actual 1,000-ounce bars to create those new ETF shares. If physical bars are tight, this process can directly drain COMEX's deliverable inventory, the stuff called registered. And if we connect this to the bigger picture, really understanding this market architecture, this plumbing, it's just non-negotiable if you want to understand a potential silver squeeze.
So let's get into that plumbing. Start with COMEX.
Okay, COMEX futures. It's the nerve center for global price discovery, and crucially, it's a delivery market of last resort for those big bars. Now, within COMEX inventory, you have to distinguish between two types.
Registered and eligible.
Exactly. Registered silver means bars that have a warrant attached. They're immediately available for delivery. Think of this as the effective float, the readily available cash in the market's till. Analysts often put this number typically somewhere between, say, 30 to 80 million ounces, though it fluctuates.
Okay, that's the key deliverable pile. What's eligible?
Eligible silver meets all the COMEX specifications for size and purity, but it doesn't have a warrant yet. It's not immediately deliverable. It's like inventory in the back room, not on the shelf.
So squeeze happens when?
A squeeze scenario really heats up when that registered inventory gets drained quickly and the owners of the eligible silver are unwilling to convert it to registered and make it deliverable at the current prices. That registered number is the one to watch most closely, not the total combined inventory. Then you have the ETFs, like SLV and PSLV. As we said, they're the primary on-ramp for retail.
Right, where most people buy in.
And the way they operate, with authorized participants creating and redeeming shares, directly links buying pressure from investors like you to the physical wholesale market.
So massive inflows matter.
Hugely. If you see giant inflows into these ETFs day after day, it forces the APs to scramble and find physical bars, which can really put a strain on the wholesale market. Remember 2021?
Yeah, you mentioned SLV had to add a crazy amount.
Over 100 million ounces, more than 3,400 tons added to its vaults in just a few days. That just shows the scale of the flows that can happen and the pressure it puts on the physical sourcing side.
And underpinning all this is the actual physical market itself, mainly in London's LBMA system, but also in COMEX vaults. That's the global wholesale pool for the big bars.
And just a crucial reminder here, don't double count the inventory. ETFs like SLV store their metal in those LBMA vaults. So SLV's holdings are part of the LBMA total, not separate from it. It's a common mistake.
Okay, one more really key concept here before we get to the specific signals, backwardation.
Ah, yes, very important.
Can you break that down? Normally, futures prices are higher than spot, right?
That's right. Usually, the futures price includes the cost of carrying the metal storage, insurance, cost of funds. That state is called contango.
So backwardation is the opposite.
Exactly. Backwardation is when the immediate spot price for silver is actually higher than the futures price. It's rare. and it's a powerful signal.
What does it signal?
It signals extreme urgent demand for physical metal right now. It means the market is saying the convenience, the benefit of having that physical bar in your hand today outweighs all those normal carrying costs. Someone needs metal now and is willing to pay a premium for it over waiting.
Okay, that's a clear sign of immediate stress. So, given all this intricate plumbing, COMEX, ETFs, physical backwardation, what are the absolute top signals a retail investor should be zeroing in on? Why are they so crucial?
That really is the core question, isn't it? Because remember, a squeeze isn't confirmed by just one signal going off. It's about a cluster of them flashing red at the same time.
Like warning lights on a dashboard.
Exactly like that. One light might be okay, but 5 flashing. You've got a problem. So here are your key real-time indicators. Number 1, absolutely critical. COMEX, registered inventory, we just talked about it. It's the effective float, the deliverable supply. What you're looking for is a rapid accelerating drawdown.
Like falling below a certain level.
Yeah. For example, if it drops consistently below, say, 150 million ounces and keeps falling day after day, that's a clear sign of acute physical offtake. Tied to that is open interest, OI, and the OI registered ratio. OI is just the total number of outstanding futures contracts. Think of them as paper claims on silver.
In the ratio.
The OI register ratio shows you how much leverage there is, how many paper claims exist for each ounce of deliverable silver. Now, a classic signal of shorts getting squeezed is when the price is spiking up, but total open interest is actually falling.
Wait, falling OI with rising price? How does that work?
It means shorts are desperately buying contracts to close out their positions, reducing the total number of contracts outstanding, even as their buying pushes the price higher. It's forced buying. Next up, front-month basis and persistent backwardation. We touched on this. You're looking for the spot price to be consistently higher than the nearest futures contract price.
How much higher and for how long?
As a rough guide, maybe 5 cents an ounce or more, and crucially, it needs to persist for, say, 3 or more consecutive trading days. A one-day blip might just be noise. Persistence signals real, urgent physical demand.
Okay, so sustained backwardation is key. What about the retail side influencing things? How do we track that?
Great question. You watch ETF creations and any signs of borrow friction, especially in the big ETFs like SLV. This is your gauge of retail-driven physical demand.
So big inflows.
Massive, sustained net inflows day after day. If this happens, it can seriously strain the wholesale market as APs hunt for bars. It becomes a really high-risk signal if it's accompanied by official warnings from the ETF sponsors about difficulty sourcing metal. Or if you see silver lease rates spiking, that indicates tightness in the lending market for bars, like when SLV had to update its prospectus in 2021. And then there's the ground-level check, retail premiums and availability.
What am I looking for there?
You're looking for premiums over the spot price to go crazy high. Think like over $15 premium just for a standard 1-ounce American Silver Eagle coin. And you're looking for major online dealers reporting they're out of stock or facing long shipping delays. During the 2021 tag silver squeeze attempt, premiums on popular retail products easily doubled or tripled almost overnight.
Wow. Okay. And for tracking the big players, the professionals.
For that, you need the commitment of traders, COT report, specifically positioning and concentration. This report shows you how different groups are positioned. A squeeze becomes much more plausible if you see that the short positions are highly concentrated in just a few large entities like swap dealers, while speculative traders, like hedge funds, are heavily net long. It highlights potential points of failure. Now, LBMA vault totals are useful for context, seeing the overall trend in the world's biggest silver pool. But the data is usually monthly, so it's not great for short-term timing. Use it more for assessing the long-term structural picture. If you understand options, the 25 delta risk reversal and activity in out-of-the-money OTM calls can be revealing. A skew towards calls, a positive or call-rich skew, means the options market is pricing in a higher probability of a large upward move. It's a sign of speculative expectation. And lastly, kind of a softer signal is the sentiment pulse. You can use Google Trends for searches like buy silver as a rough proxy for retail excitement or panic. A parabolic spike there, especially if it coincides with stress signals in the actual plumbing, like falling registered, is a high-risk indicator.
And the broader economy.
Right. Don't forget the macro anchors. Things like falling real interest rates and a weaker U.S. dollar generally support silver prices. They provide context, but they aren't timing signals on their own.
Okay, that's a fantastic list of signals. Really comprehensive. Now, let's try and tie it all together. How does a full-blown silver squeeze actually, unfold? What's the typical sequence of events? Understanding that helps make sense of the signals.
Yeah, visualizing the sequence is key. It usually starts with some kind of catalyst.
Like what?
Could be a major government policy shift, a significant mine supply disruption, or maybe even a well-coordinated social media campaign that suddenly goes viral. You see Google Trends for buy silver spike, that catalyst triggers the retail rush. You get this massive wave of buying hitting all the retail channels, online dealers, coin shops, premiums on coins and small bars surge, dealers start selling out. And critically, you see huge inflows pouring into the silver ETFs. Those ETF inflows create wholesale strain. The authorized participants are now under immense pressure to create new ETF shares to meet that demand. So they're scrambling, trying to source those big 1,000-ounce bars, primarily from London.
And if London's tight?
If London's tight, APs might try hedging their risk by buying COMEX futures contracts, or they might even start making plans to take physical delivery directly from COMEX vaults.
Okay, so the pressure starts moving towards COMEX, and this is where the market really starts to buckle.
This is where you get the market inversion. That physical demand starts draining the COMEX registered inventory noticeably. The OI registered ratio spikes upwards. And crucially, the futures curve flips into that persistent backwardation we talked about. Spot price stays stubbornly above futures.
And the shorts.
The shorts are now starting to feel serious pain. Their positions are deep underwater, and the cost to borrow physical silver might be rising too. This pressure cooker environment leads to forced buying. Panic starts to set in among those short sellers. They realize they might not be able to roll their positions or find physical metal easily. They are forced to buy back their short futures contracts, almost regardless of price, just to get out.
Driving prices vertical.
Exactly. And remember that weird signal. Total open interest starts to fall sharply, even as the price is exploding upwards because shorts are closing out. At the same time, you might see aggressive speculative buying of call options, which forces the dealers who sold those options to buy futures themselves to hedge their own risk, adding even more fuel to the fire. But just as things look like they're going parabolic, intervention.
The exchanges step in.
The CME group steps in. This is almost inevitable near the peak. They'll announce a series of sharp margin hikes. We saw this clearly in 2011, 5 hikes in about 2 weeks, raising the cost to hold a long contract by over 80%. That's basically the game over moment for the squeeze's upward momentum.
Yeah.
And unfortunately, that intervention usually leads to collapse. The margin hikes force anyone holding long positions with leverage to sell, often violently, to meet the higher margin calls.
Yeah.
This liquidation cascades, causing the price to crash hard. Liquidity dries up instantly. It can take weeks or months for the market to stabilize and for things like premiums and inventories to get back to some sort of normal.
Wow, that sequence really paints a picture. Intense. It also really highlights why those historical examples you mentioned earlier are so important. They aren't just history lessons. They show us the playbook, right? Like the 1980 Hunt Brothers saga. They tried to corner the market, bought up something like 100 million ounces.
A huge chunk of the available supply back then.
And the price went from maybe $6 to almost $50. But then COMEX brought down the hammer with Silver Rule 7.
Liquidation-only trading. Massive margin hikes. Game over.
The lesson there seems crystal clear. Exchange power is absolute. They will change the rules. Don't bet your house against the exchange. Then fast forward to 1997-98 and you have Warren Buffett. Berkshire Hathaway quietly bought nearly 130 million ounces.
But based on fundamentals, right? A supply-demand deficit he saw.
Right. Price went from around $4.50 to $7. And importantly, silver lease rates went through the roof, signaling real physical tightness.
And minimal intervention that time.
Because the market found a balance, shorts paid up. The lesson. A large, unleveraged buyer demanding physical can seriously stress the system. It doesn't have to be just short covering.
Then 2008, the global financial crisis. Bear Stearns was caught with a huge concentrated short position in silver.
Price spiked briefly, $16 to $20 or so, before everything melted down.
The key takeaway there was the danger of that concentrated short position. It becomes a systemic weak point. That's why monitoring the COT report for concentration is so important. And the 2010-11 run up to almost $50 again, driven by post-GFC money printing, safe haven buying, lots of speculation.
And what ended it?
Same playbook as 1980, essentially. The CME hiked margins 5 times in quick succession, over 80% increase in cost. Bam! Price collapsed. Lesson. Expect those rapid-fire margin hikes when things get really frothy near a top. And finally, the most recent big event. 2021's hashtag silver squeeze. The Reddit Wall Street silver effort.
That one got a lot of attention.
It did. Huge ETF inflows. SLV saw 110 million ounces come in one day. Retail premiums for coins and bars went absolutely nuts, doubled and tripled. Dealers were cleaned out temporarily. Price popped from $27 to $30 briefly.
But it didn't last. It fizzled. Why?
Because crucially, it didn't manage to significantly drain the wholesale 1,000-ounce bar market or the COMEX registered inventory. The pressure stayed mostly at the retail end, and the CME was proactive, hiking margins 18% fairly early on.
So the lesson from 2021.
Retail buying power is impressive, but on its own, it's not enough. You have to put significant stress on the institutional wholesale delivery mechanism, the LBMA and COMEX system, for a true sustained squeeze. Silver's wholesale market is just incredibly large and liquid.
These historical precedents are just invaluable context. Okay, so building on those lessons and all the signals, you mentioned a practical tool, the Squeeze Stress Index, or SSI. Tell us about that. It sounds like a way to quantify the pressure.
Exactly. Think of the SSI as a conceptual fever gauge for the market's plumbing. It's designed to provide a more objective, disciplined way to assess the situation, cutting through the emotion and hype that always surrounds silver.
How does it work? What goes into it?
It basically takes several of those key signals we discussed, looks at where they are relative to their recent history using percentile ranks, and combines them with specific weightings based on how directly they measure stress.
Okay, what are the big components?
The heaviest weighting, 25%, goes to the registered inventory divided by open interest ratio, but inverted, because that's your most direct measure of physical tightness relative to paper claims.
Makes sense. What else?
Then you've got basis backwardation severity at 20%. ETF net creations, looking at the trend over 4 weeks, get 15%. The options 25 delta risk reversal, measuring that call richness or upside expectation, also gets 15%.
And the positioning and sentiment.
Right. COT top 4 or top 8 short concentration gets 15%. And the sentiment pulse from Google Trends gets the final 10%. So you combine all those weighted scores.
You get a number. How do you interpret that number? What's high, what's low?
Generally, if the SSI scored below 50, things are pretty normal. Between 50 and 70, it's a watchdown. Conditions are getting interesting. Pay closer attention.
Okay.
From 70 to 85, that's elevated. Multiple warning lights are flashing now. This is when you should probably be prepping potential trades or hedges and definitely tightening up your risk management.
And above 85?
Above 85 is high risk. A squeeze regime is likely underway. You should absolutely expect exchange intervention risk to be high, and it's probably wise to deleverage any futures positions. Now, here's the critical insight, the nuance in using this. A high SSI score, driven primarily by the fundamental plumbing signals like rapidly falling registered inventory and deep, persistent backwardation, that's a credible threat.
Okay.
But a high score driven mostly by just sentiment, like a massive Google Trends spike while the plumbing looks okay, that's often just a hype-driven trap waiting to snap back. Need the fundamentals to back it up.
That's a really useful distinction. Okay, so we have the signals, the history, this SSI gauge. What does this all mean for your approach as an investor? It sounds like you need different playbooks for different situations. Absolutely. It's not one size fits all. You need to match your strategy to the market state and, crucially, your own tolerance for risk. So let's talk playbooks. What's the base case? Like, if silver is just in a normal, orderly uptrend?
In that scenario, you typically maintain your core long-term exposure. Maybe through physically backed ETFs, things like PSLV or SIVR are popular choices, or by holding actual physical metal bars or coins.
Add-on dips.
Yeah, maybe add-on pullbacks using dollar cost averaging. The key here is to avoid significant leverage. Just participate in the trend.
Okay, but what if things get wild? What's the squeeze case playbook? Let's say the price starts going vertical, like 15, 30% or more in a short period, and the SSI is flashing red.
Right, the disorderly spike. In that situation, the smart move is usually to harvest partial gains into strength. Sell a portion of your position as the price screams higher.
Why sell into strength? Isn't the point that it goes higher?
Because, intervention risk, those margin hikes, is becoming extremely high. So you reduce or even exit leverage futures positions entirely to lock in profits and get out of the way before the hammer drops.
But maybe keep some skin in the game.
You could maintain some exposure, perhaps through longer-dated call options, which have defined risk, or stick with your core physically backed ETF holdings. The absolute key is don't chase the spike with leverage. Don't buy illiquid retail products with insane premiums. And definitely don't believe anyone telling you the price is going to infinity. Have an exit plan. Now, for someone who wants a very conservative playbook, maybe long only, very low risk.
Yeah, what's the approach there?
Stick to the basics.
Yeah.
Physical bars and coins stored securely, or physically backed ETFs like PSLV, SIVR. Use dollar cost averaging to build your position over time. And the absolute rule, zero leverage, none. And for the more experienced traders, those comfortable with derivatives, the advanced playbook.
What options are there?
You might look at using defined risk option strategies like vertical call spreads to speculate on a price rise while limiting your potential loss. But the absolute #1 rule for advanced players in a suspected squeeze regime: never, ever be naked short volatility. Meaning, don't sell uncovered call options or put options. The potential losses are theoretically unlimited if you get caught on the wrong side of a massive volatile move. It's just not worth the risk. And underpinning all these playbooks are some universal risk rules that apply to everyone, regardless of your strategy.
Okay, lay them on us.
1. Assume margin hikes will happen to your blow-off tops. Expect them. Keep a cash buffer ready so you aren't forced to liquidate if they hit. 2. Never size your positions based on a guaranteed squeeze. It's never guaranteed. 3. Have predefined exit plans. Know where you'll take profits and where you'll cut losses before you enter the trade. 4. Verify all data yourself from primary sources, CME, LBMA, ETF sponsors. Don't trust random screenshots or rumors on social media.
That's incredibly practical advice. Okay, alongside the playbooks, it's also crucial to be aware of common misconceptions and pitfalls. What are some of the big red flags, myths, and pitfalls that retail investors should watch out for?
Yeah, this is important for avoiding costly mistakes. So first, a huge myth is double counting inventory. We mentioned it before, but it bears repeating. You see people adding total LBMA vault holdings to total ETF holdings. You can't do that. ETFs like SLV store their metal in those LBMA vaults. It's counting the same silver twice and inflates the perceived supply.
Okay, check. What else?
Another common myth is the paper-to-physical ratio panic. You'll hear things like, oh, the ratio is 30-to-1, default is tomorrow. These ratios can be misleading and fluctuate wildly. What really matters isn't the absolute ratio, but the trend and level of deliverable inventory that COMEX registered number and whether owners of eligible silver are willing to convert it. Focus on registered, not just a simplistic ratio. Also, beware the myth that one-day backwardation at crisis. A single day where spot flips above futures can just be market noise or a temporary settlement issue. A true actionable signal requires persistent backwardation over several consecutive trading sessions, ideally confirmed by other stress indicators like falling registered inventory.
Good point on persistence. What about risks related to the investment products themselves?
Absolutely. There's risk from prospectus confusion. People need to understand that owning shares in a silver ETF, even a physically backed one, is not the same as owning specific allocated segregated silver bars in your own name. Read the prospectus. In times of extreme market stress, the ETF sponsor might even temporarily suspend the creation of new shares. If that happens, the ETF price can disconnect from the underlying silver price. And don't forget broker or platform risk. During periods of extreme volatility, like a squeeze attempt, your online broker might experience technical outages. They might suddenly halt buying of certain silver instruments. They might unilaterally increase margin requirements on futures or options way beyond the exchange minimums. Or, if you're shorting, they could even recall borrowed assets. This operational risk goes way up during chaotic markets. And maybe the biggest red flag of all, social media certainty. Be extremely wary of narratives online proclaiming a guaranteed imminent squeeze is about to happen, often with outlandish price targets. Always, always demand independent confirmation from at least 2 of those core plumbing signals we discussed, like falling registered and persistent backwardation before you give any real credence to hype, especially hype driving a sentiment spike. Require proof from the market itself.
That's a great reality check. Okay, to wrap all this practical advice together, let's give people a simple, actionable, weekly monitoring checklist. Something they can actually do routinely to stay disciplined and informed without getting totally lost in the data. So maybe every Friday or end of the week, what should you check? First, the COMEX registered level and its 4-week trend. Get the data from the CME Group's daily silver stocks report. Is it below, say, 150 million ounces and trending down consistently? That's a flag. Next, open interest, OI, and the OI registered ratio. Calculate that ratio. Is it rising fast? That's one flag. Is OI actually falling while the price is strong? That's an extra flag, potential short covering. Then, check the basis backwardation. Compare the closing spot price to the closing front month futures price. Is spot higher by 5 cents or more for 3 or more consecutive sessions? Flag that. Look at ETF flows. Check the official websites for the big ETFs like SLV and PSLV. What's the net change in ounces in trust over the last week and the last 4 weeks? Are there any official notices from the sponsors about sourcing metal? Dive into the COT report, Commitment of Traders, from the CFTC, usually out on Fridays. Check the managed money net long position. And crucially, look at the concentration ratio for the top 4 or top 8 swap dealers on the short side. High concentration. Flag it. Get a feel for retail premiums. Go to a couple of major online bullion dealer websites. What's the premium overspot for a 1-ounce American Silver Eagle? For a generic 1-ounce round, are they reporting out of stock or delays? Check sentiment. Pull up a weekly Google Trends chart for the search term buy silver. Is it spiking upwards sharply? And finally, glance at your macro strip. What's the current 10-year real interest rate doing? What about the US dollar index, DXY? Just for background context. So what's the action box here? If you see, say, 2 or more of those squeeze regime level flags triggered across this checklist, especially the core plumbing ones like registered inventory and backwardation, and the overall picture looks broadly stressed, that's when you seriously consider reducing leverage, maybe shifting to defined risk options strategies, and definitely mentally preparing for the possibility of sudden margin hikes from the exchange.
Wow, okay.
That checklist provides a really solid routine. I think this whole deep dive using this guide has really equipped everyone listening with a much clearer framework for understanding and navigating the really complex, high-stakes world of silver short squeezes.
It really boils down to this. Knowledge and discipline are your absolute best allies in this market.
And maybe a final thought to leave people with. Remember, the silver market, despite its huge size on paper, has a surprisingly delicate balance. It's a balance between all those paper promises and the actual physical reality of the metal.
Right.
The question isn't just if that plumbing system will eventually seize up under the right conditions, but perhaps more importantly, whether you'll be prepared to recognize the signs when it does, and then how you choose to participate, or maybe choose not to participate, in that very unique, potentially chaotic moment.
That's a powerful thought to end on. If you found this deep dive valuable, please do us a favor, like this deep dive, and definitely subscribe to the 1 Troy Ounce YouTube channel for more insights like this. Now, just a quick but really important note before we go. This deep dive was generated with the assistance of AI and is strictly for informational and educational purposes only. It is absolutely not investment advice, nor is it a solicitation to buy or sell any security or financial instrument. That's right. Trading derivatives, including futures and options, carries a very significant risk of loss, potentially more than your initial investment. Market conditions can change incredibly rapidly, and as we discussed, exchange interventions can radically alter market dynamics without any prior notice.
So all investors must conduct their own thorough due diligence and should consult with a qualified independent financial advisor before making any investment decisions. Seriously, remember, always do your own research.